Will the Fed burn the dollar or asset prices? So will the Fed destroy the US dollar or asset prices? This really is the big question that all investors need to ask themselves right now, because central banks around the world have backed themselves into a corner, and really they've got two choices: either destroy the currency or destroy asset prices. They cannot do both. So what I want to do now, before we get into this video, I've got a lot of charts in this video to share with you guys. Let's just cut to a 1-minute clip from Jerome Powell speaking at Jackson Hole.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
So I did this video, Don't Fight the Fed, almost 5 months ago now, where Jim Bianco really put the strongest argument as to why the Fed would raise rates, they would not pivot, or at least not pivot straight away, and the asset prices will come down. And former Fed trader Joseph Wang also said, don't fight the Fed. Don't fight the Fed when they're lowering rates, and don't fight the Fed when they're raising rates. And I'll put a link in the description below if you guys haven't watched it, but I was very much in the camp that the Fed and other central banks would pivot. And we'll come to that as to why I thought that. But it was back then that I realized that actually there's a political issue here. And I jumped sides. And it seems that, well, the Fed, at least in Jerome Powell's speech, has made it clear what he's going to fight. So Jerome Powell said that reducing inflation is likely to require a sustained period of below-trend growth, but failure to restore price stability would mean far greater pain, as you saw from that clip. Fed Chair also said that another unusually large increase could be appropriate at the next meeting, but the decision will depend on incoming data. The Fed Chair harked back to the lessons of the 1970s when the US Central Bank presided over a period of turmoil after it made several policy blunders and failed to rein in inflation. That forced Paul Volcker, who became Fed Chair in August 79, to choke the economy and cause more pain than would have been necessary if officials had acted more quickly. The historical record cautioned strongly against prematurely loosening policy, said Powell as he explained that interest rates will need to stay at a level that restrains growth for some time. The main lesson of that period was that central banks can and should take responsibility for delivering low and stable inflation, he said, reiterating that the Fed's unconditional commitment to tackling price growth. He also highlighted the risk posed by inflation remaining too high for too long, setting off a chain reaction whereby people come to expect further price increases, and then it develops into hyperinflation when people expect prices to rise next week. Well, what do they do with their dollars? They go and spend it straight away because they know it's going to be devalued, and that becomes a self-fulfilling prophecy. So what's also interesting is the number of uses in Chairman Powell's remarks at Jackson Hole regarding maximum employment. 0. So in 2020, he mentioned it 12 times. In 2021, 10 times. But yeah, in 2022, maximum employment, 0. So that's a sign of what he's focusing on. Now, this was the markets before Jerome Powell's speech. And this was the market after Jerome Powell's speech. Now, what's interesting with central bankers is their forecasts. All those PhDs at the Fed and all the central banks around the world, and their forecasts always end at 2%, yet they're always wrong. Always wrong. All right, so this chart here is one reason why I thought that central banks were trapped and that they couldn't raise, or they'd raise a little bit and they'd be forced to pivot. And that's because when you compare the 1970s, when central banks did raise rates and the Fed did raise highly, US debt to GDP, and this is comparable around the world, was very low. Where today debt to GDP is at nosebleed levels. And so, we don't need to raise rates as high as back in the 70s to cause extreme damage because of the debt levels that we've got right now. And I've said this, that if, the old Taylor rule, if the actual federal funds rate goes above the actual CPI rate, then we're going to have an almighty depression. What I'm hearing is that from all the different Fed presidents is that they want 4 to 5% OCR, and left there for some time, even in a recession. So 4 to 5%. That means in Australia that and other countries around the world, well, they need to raise their rates. Otherwise, they put pressure on their currencies. If they don't raise rates, then their currencies are going to fall, which then means their import costs, their import prices, and their input costs rise significantly, and then they they have a CPI problem. So if the Fed forces the world to raise rates, that's going to put pressure on asset prices significantly. And here's a chart of global liquidity and world wealth, and the dotted line there is what the Fed is saying they're going to do regarding liquidity. And that is less liquidity in the markets than during the GFC. So, this is going to have a big impact on all asset classes, including gold and housing. And here's a chart of worldwide US dollar monetary base and global liquidity index, and it's projected to remain negative for quite some time. So as liquidity gets taken out of the market, that means there's going to be less US dollars. This is going to create an issue in emerging markets in particular, and we could see some balance of payment crises around the world. Europe, I think, are in a world of pain. And here's a chart of US money market net inflows in red and the S&P 500 in orange. And the trend for US money market net inflows is negative and will continue to be negative. And if we get yields like we've just seen, the highest 2-year US Treasury yield since 2007, then that there is no alternative, Tina. Well, there does become an alternative, and you will see some capital move back into yields. As much as I think that bonds suck, there will be people that go into them to get yield. And that is going to suck liquidity out of other asset classes. So let's look at house prices. We'll start in New Zealand because their central bank really were the first central bank to start raising rates significantly. And, well, you can have a look at that. Price drop from peak and then fall since peak annualized. These are big price drops in just, not even a year. We haven't even reached 12 months yet. And this is how large these house price falls are going. And anyone who thinks that the interest rate hike cycle has come to an end is kidding themselves. And same thing in Canada. So Canada, they've seen almost a 10% correction across the board. Now, I have heard from individual mortgage brokers and other people in Canada who say different areas in Canada have had very large declines, similar to New Zealand. So watch your space. And in the US new home sales have fallen to their lowest level since January 2016. At the same time, the supply in houses have hit the highest level since just prior to the global financial crisis. So less sales, more supply. And here's the two charts put over the top of each other. You can see the supply, it's the second highest, or highest since just before the global financial crisis. At the same time, that home sales is really starting to fall off a cliff. So here's a chart that goes back almost 25 years, the Case-Shiller House Price Index and regression. And, well, I'll let you guys work out where house prices are going. Now to Australia, from the guys at Macro Business, Australia braces for record housing collapse. Quillibar Capital's Chris Joy gave another dissertation on Australia's housing market, which he says is headed for a record collapse that is only likely to get worse as the RBA aggressive rate hikes bite. And we are behind the rest of the Western world regarding our rate rises. So I'm not going to read all that. I'll let you guys pause the video and read it if you'd like. So you can see in this chart since May, house prices in the capital cities, how they've fallen. And it's falling at the fastest pace of decline since 1983, when official records were kept. And Leith Van Onselen reminds us that if the futures market gets its way, the official cash rate is lifted to 3.6% by middle of next year, implying an average discount variable mortgage rate of around 7%. And Australia is facing its biggest house price crash in living memory. Now remember, in 2020 and 2021, a lot of people took out 2 and 3 year fixed rate mortgages. Now, big chunks of those people roll off onto variable rates, or they can refix, but fixed rates are much, much higher now. So they're coming off fixed rates of 1.89, 1.99% next year, around the same time that the official cash rate is expected to be around 3.6%. The Australian economy would also risk a recession via the negative transmission to household consumption, the Keynesian wealth effect, which is easily the biggest driver of growth alongside dwelling construction. Well, just a Ponzi scheme, economic Ponzi scheme. So here's the latest August data, and Brisbane has now overtaken Melbourne, falling faster in the month of August. Melbourne, Sydney still leading the way. So there's a rental crisis right around the world, and everyone's trying to work out why, and people have got lots of different theories. I've got my own theories as well. But this new Greens MP has recommended that we freeze rents. We have a rent freeze for 2 years. So price controls, and we're hearing that around the world as well. We need price controls. Well, we know what happens with price controls. We have empirical evidence. We have history to go back on. Price controls don't work. In fact, they make the problem worse. Now, what's not taken into account is the Chinese property market. No one's talking about this at the moment. Everyone's focusing on other things, yet the Chinese property market is in big trouble. Big trouble. And this is yet to play out across the global economy, and especially for Australia, our housing market, and also Canada. I think Vancouver, you guys have a lot of Chinese investors in Vancouver, and I believe in California, and also in places like Auckland and New Zealand. And here we've got the S&P Global US Composite PMI Index and the US GDP, and, well, that's not looking too flash either. So there's a lot of talk about countries around the world de-dollarizing, and there certainly is that trend happening. However, it's easier said than done. And you can see from this chart, global Treasury reserve holdings, although the trend is beginning to go down, it's still relatively elevated historically. But the one thing that we can notice from this chart is the amount of gold reserves. That is clearly in a trend. Since 2018, that is clearly in a trend upwards, and I expect that to continue. So it's clear that especially some countries like Russia and China, etc., are trying to de-dollarize faster. And it's true, China has reduced their holdings of US treasuries. We don't know how much gold they own. Frankly, I don't trust them anyway. But there is that happening. So this is all, there's so many things playing out right now. And last week, we saw the Italian 10-year bond yield go vertical. And if it wasn't for the ECB buying it and buying other European government bonds, then Europe would be stuffed. And this goes into the whole dollar milkshake theory. So a lot of people ask me, okay, Steve, cool. So you think interest rates are going to rise? We've got inflation. We've got all these problems, huge debt bubble. Well, where does someone invest? You know, should we go into bonds? 4.5% yield here in Italian bonds. Should we buy it? Should we be buying gold and silver, physical gold and silver? Should we be buying gold and silver miners? Should we be buying growth stocks? Should we be buying real estate, farmland, commodities? How do we play this? And look, two things. One, if you guys want to know how I'm invested, my whole portfolio, then sign up for Finance Uncut Insiders, where we'll send a weekly report out to you guys with our portfolio and all of our trades and all of our research and analysis. If you want that, it's a 12-month subscription for the weekly newsletter. It is $1 a day, $365 for an annual subscription, but we are, for the launch, discounting it by 30%. So it'll be $255.50 US. That's in US dollars for the report. Now, a lot of people ask, oh, Steve, you're Australian. Your portfolio is predominantly Australian, right? So if I'm in the US, why would I want to subscribe? Well, actually, our current portfolio is about 60% Australian stocks or 60% Australian assets, 40% US assets. But there's periods of time where that's been 70 or 80% US assets and only 20 or 30% Australian assets. So, and then we occasionally do invest in other countries as well. Canada, UK, Japan, Russia, we won't talk about that. Indonesia, India, etc., etc. So if you're interested, just send an email to the email address below. If you're interested in Finance Uncut Insiders. But I am also going to talk more about this in our next video. I'm going to talk more about the dollar milkshake theory and why it makes sense to me. A lot of people say, Steve, why are you holding so much US dollars yet you think there's inflation? You've been calling inflation for the last 2 years. You're heavily invested in gold and silver. You're heavily invested in gold, silver miners and commodities and other inflation hedges. Why are you holding dollars for? Well, I'll talk more about that in our next video. And I'll talk more about the different asset classes that we are invested in based on this whole global macro outlook, and using, of course, Austrian economics as our foundation. So stay tuned for that. You'll hear more about that in our next video. But if you are interested in Finance Uncut Insiders, the weekly report, send an email to the email address below. We will get back to you. We haven't got back to anyone yet. We are trying to get a minimum number of people to make this service viable, as I need to step down from other roles in our business to do this. So if you are interested, send me an email. We're getting closer. We're getting closer. We're not too far away from that number that we need. So, but stay tuned for our next video where I'll give more information about how we are invested based on this global macro outlook. Anyway, guys, if you like this video, would really appreciate it if you hit that like button. Love to see your thoughts and opinions in the comments below. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.